3 Commercial Banking Assignment on Commerce Bank. Within our group, we have Daniel, Dominique, Oswald, Jessica, and George. When evaluating the performance of financial institutions, a key focus is on the analysis of financial ratios, which offer valuable insight into their operational efficiency, profitability, and overall financial health. For Commerce Bank, the analysis of various financial ratios provide a comprehensive overview of its asset utilization, profitability, and leveraging capacity. One such metric is asset turnover, which indicates how effectively the bank is utilizing its assets to generate revenue. In the case of Commerce Bank, this ratio highlights the efficiency of its operation. The profit margin ratio provides insight into the bank's financial performance by comparing total operation income against its expenses. Additionally, the return of assets ratio measures how well the bank's assets are used to generate profits, with fluctuations providing insight into both market conditions and internal operations. Similarly, the equity multiplier indicates the extent to which the bank is leveraging debt to finance its assets, revealing the level of risk it is taking on to fuel growth. All of these ratios culminate in a return of equity, a key indicator of profitability that shows how effectively the bank is using shareholders' equity to generate returns. These ratios are essential to understanding how well the bank is performing, as they offer the framework for both internal assessment and comparison with industry peers. Through this analysis, Commerce Bank can gauge its financial standings, assess internal operations, and develop strategies for further growth. These performance indicators, combined with trend analysis and industry benchmarks, provide a crucial foundation for understanding the bank's position in the competitive landscape of the financial sector.
Good evening, guys. Today we'll be diving into the financial performance of Commerce Bank for the full year 2023. We'll break down the financial ratios to understand how the bank performed and how it stacked up against industry trends. We'll start with the asset turnover. In 2023, Commerce Bank assets turnover stood at a solid 4.8%. This ratio tells us how effectively the bank assets were used to generate revenue. Essentially, for every dollar in assets the bank earned, a solid 4.8% in operating income. Next, we'll talk a little bit about profit margin, which in 2023, Commerce Bank achieved a solid 65.9%. This means that for every dollar of revenue, the bank essentially kept a solid 65.9 cents as a profit. Though slightly lower than previous years due to higher cost, they remain strong, showcasing the bank's efficiency. Now we're going to move into return on assets, the ROA. For Commerce Bank in 2023, the ROA was 3.2%. This metric reflects the profit the bank earned for every dollar of asset it held. While the ROA has dipped slightly compared to last year, same as the profit margins, it still provides an insight on the bank's ability to generate profits as an asset base. Okay. Now, talking about equity multipliers, the equity multiplier for 2023 for Commerce Bank was a solid 13.2. This ratio shows us how much the bank assets are funded through debt versus equity. Though slightly lower than the previous year, like the profit margin and return on assets, This still indicates that the Commerce Bank has a solid balance between debt and equity financing, helping the bank manage its own risk. When we combine all these factors, we get the ROE. In 2023, for Commerce Bank was a strong 41.7%. This number shows how much profit the bank has generated for every dollar of equity invested. While a bit lower, just like the other ratios from previous years, this factor, like bad debt and higher than usual expenses, can be attributed to that lower than usual percentages earned. Still represents a healthy return on investment at a solid 41.7%. Looking at the bigger picture for the bank industry as a whole, it has faced many ups and downs over the years. Or from the early 2000s economic downturn of the housing market in 2008 to the challenges brought on by COVID 19. Profit margins have fluctuated up and down. However, many of the banks, commerce banks included, have remained resilient throughout this fluctuation and downturn of many things happening in the market. For Commerce Bank, the story is one of stability. Okay, this bank from 2019 to 2023, the bank has maintained a solid profit margin. Even though we have gone through pandemics, the profit margin 2023 dipped slightly to a 65.9%, still stronger than many of the industry averages of 24.7% for the same time period. Now, comparing the broader industry, which faced challenges in 2023, uh, Commerce Bank remained resilient. They didn't stop on their financial foundation, keep building it up. They adapted to the many challenges that it faced during these times. In conclusion, 2023 for Commerce Bank represents uh, and shows the financial ratios of one of its solid and resilient performance. Okay, these numbers by the bank track their growth benchmark against their peers, and they are used to plan for their future as they continue to grow and continue to expand in the market. Thank you for listening to me a little bit talking about a Commerce Bank and the ratios. We have coming up next, we have Daniel, Dominic, and team that will continue to explain further key areas of Commerce Bank. Thank you, guys.
Hello everyone, my name is Joshua Gonzalez, and in this presentation I'll be touching some of the fundamental underpinnings of Commerce Bank's financial performance. Being the first, net interest margin. This is a metric that measures the profitability for banks by comparing the interest income with the paid cost for interests. After performing a 5-year analysis on the net interest margin for Commerce Bank, which we did 2019 to 2023, we could observe that they have an average of 3.012, which falls a little short when comparing to the industry's average, giving us the idea that they have generated less income by interest during this period. During the COVID-19 pandemic, which hit our economy in 2012, interest were really low, and this directly affected the bank's interest margins. Another underpinning is allowance for loan loss as a percentage of assets. Allowance for loans losses is a reserve amount that the bank is needed to put aside to offset any possible bad debt or to cover from potential unpaid debt by its borrowers. In our analysis, we can also see that the percentage ratio decreases as the pandemic passes by. Many factors could contribute to this. For example, one of them is that a huge release aid package was approved by the government, and this gave families extra money, and this was in repeated time, like I think it was 2 3 times, and that helped out a lot. Another underpinning, loans to core deposit ratio. The loans to core deposit ratio is used to measure the proportion of loans that the bank is backing up with its core deposits. The core deposits are their most stable, known, and safe to access deposits. This ratio is key to evaluate the liquidity and financial health of any financial institution. In the analysis we can observe that Commerce Bank have a bigger higher average loans to core deposits ratio that the average industry, and this can put them in a disadvantage in terms of financing and financial health. It is understandable that the ratio is bigger, since when we think about a Commerce Bank or when we think about banks, Commerce Bank is not between the first 10 choices that comes to mind, and they don't have deposits, and maybe due to this they don't have deposits as big as one of the following banks, such as Wells Fargo, Bank of America, JP Morgan, Citibank. Another underpinning loans on a ratio, or loans to asset ratio. The loans to asset ratio is used to measure what percentage of the bank total asset is composed by loans. It is useful to study the bank financial structure and its risk profile. We can observe that the bank's loans to asset ratio is fairly it's almost on par with the average industry, and this means that the bank's loan stance is aligned with all the other banks. We can observe that the ratio started increasing after the pandemic ended, which could directly correlate with the economic expansion that the United States suffered after the pandemic, with many new businesses, especially technology, which boomed and did really well after pandemic in those years. Another underpinning ratio, cost efficiency ratio, non-interest expense divided by operating income. It is used to measure how efficient a financial institution is to manage its operative costs in relationship to its income. Basically, the lower the ratio, the more efficient the bank is to operate, and the lower the ratio, the more efficient the bank is to manage its operative costs, since they are expending less money to operate. This ratio also allows the bank and investors to identify areas for improvement, because if the ratio is high, the bank needs to adjust and look for new ways to reduce its costs. After looking at the evaluated years, the analysis, we can see that the bank maintains a similar ratio, which is lower than their competitors in the industry, which it could help them a lot on their financial well-being, because of the bank, and they can demonstrate how good the executive teams when they need to manage costs in each of the departments. And the last one is equity to assets ratio. This is one of the most important ones for any business or financial institution that is traded on public markets. This ratio gives investors the idea how much the proportion of its total assets is financed with equity instead of debt. And in the analysis, we could observe that the equity to asset ratio fell below the industry average, and we can also see that the numbers been decreasing year to year, and this could mean that the company has been performing really well and is depending less on debt, on their liabilities to operate. Thank you so much, and now I'll give the word to my following colleague.
Good afternoon, everyone. I'll be covering three key areas of Commerce Bank's performance: non-interest income, portfolio income, and deposit funding. These areas are crucial in understanding the bank's revenue diversification, lending strategy, and financial stability. Non-interest income. Commerce Bank generates $573.5 million in non-interest income, making up 36.4% of its total operating income, which is in line with the industry average of 30 to 40%. The largest contributors are bank, credit transaction fees, which are 34.7%, and trust fees, which are 26.5%, showing a strong focus on payment processing and wealth management. This diversification helps stabilize revenue even when loan demand fluctuates. Loan portfolio. Commerce Bank's loan to assets ratio is 51.7%, slightly below the industry average of 55%, indicating a conservative lending approach. The loan mix includes 43.6% commercial loans, 35.2% real estate loans, and 21.2% consumer loans. This balanced distribution minimizes risk, ensuring the bank isn't overly exposed to one sector. Where deposit fundings are concerned, deposits make up 84% of Commerce Bank's total assets, which is higher than the industry average of 78 to 82%. A strong deposit base means the bank relies less on external borrowing. 35.4% of deposits are non-interest bearing, lowering funding costs and boosting profitability. This gives the bank a competitive edge in maintaining stable operations. In summary, Commerce Bank maintains a well-balanced revenue model, a diversified loan portfolio, and strong deposit funding. These factors position the bank for sustainable growth and financial stability. Thank you.
Analysis of Commerce Bank for 2023 highlights its strong profitability and resilience despite economic fluctuations. Key financial ratios such as return of equity, profit margin, and asset utilization indicates that the banks maintain efficiency in revenue generation and operational management. However, a decline in return on assets and a slightly lower equity multiplier compared to previous years suggests some impact from market conditions and internal cost structure. Despite industry challenges, Commerce Bank has demonstrated stability in key metrics, outperforming industry averages in several areas. The bank's ability to maintain a strong net interest margin and manages its loan to core deposit ratio strategically reflects its prudent risk management and financial health. Going forward, Commerce Bank can leverage these insights to refine its business strategy, optimize asset utilization, and strengthen its position in the competitive banking sector. Thank you for listening to our presentation.